Hi guys, very warm welcome to all our viewers on Money Control. This is Gamechangers Masterstroke. It's the fourth edition. It's an ongoing series that we've got for you time and again, where we educate you about different asset classes. We tell you how to go about investing, and of course, riding the host of developments, volatility, inflation fears, etc., amid your investment journey. Today, we will talk about commodities, which are the preferred asset class to invest in amid rising inflation. And to talk about that, joining me is Mr. T Gnanasekar. Thank you so much for taking time out.
My pleasure, Karuna.
Well, before we delve deeper into commodities, the various options that investors have at this point, I'd like you to flag off to our viewers how, uh, you know, um, how we have performed in the last 1 year odd. I mean, commodities is something you've been tracking so closely. So can you shed light on, how what we have been recommending to our viewers for about a year now and how it has played out?
Karunya, what basically we have been, trading these commodities. We've largely been doing non-agri commodities, which is gold, silver, copper, and crude. So the performance is essentially related to that. And on a weekly basis, we track this, the kind of trading calls and strategies that we give to our clients, and then come up with this performance report at the end of the year as to how well our trading calls have performed, uh, and what is the potential profits one can make, and it also gives you the kind of profit and losses at any point in time. Uh, so I'm very happy to say that the 2021 PNL looks quite healthy. They've done something like a 80 to 85% sort of a return on a capital of 10 lakhs, which we have hypothetically assumed, taking into account all the margins of different commodities. So this particular table here, you know, points out how well our calls have performed month on month, uh, right from November 2020 to October 2021. So you would notice there are some negative months here and there, but largely,
Yeah.
despite the negative months, the return has been uh, quite good, roughly around 83%. And the next table below shows the number of calls that we have generated, trading calls on commodities, and the number of profitable calls and the number of loss making calls. And the strike rate comes to around 73.2% or thereabouts. That's the rough strike rate, which means we've been right 73% of the times. Uh, we've used a combination of fundamental and technical analysis to arrive at these trading calls. And we strictly adhere to stop losses. And most of these calls are positional in nature. When I say positional in nature, intentionally, we don't try to give any intraday calls.
Okay.
But sometimes the positional calls that we give, the way these markets move these days, the targets are met during the same day or during the trading day itself. Then it tends to become an intraday call, but largely we try to give only positional calls. And
Okay.
so this is the final performance, the numbers which you see on a margin of 10 lakhs, which you have deployed, a net profit of 18 lakhs 29,955
Hmm.
is the return on the trading calls.
Makes sense. But if we talk about our theme of today's discussion, which is providing some kind of protection or hedging against inflation, when we talk about phenomena like inflation, what first comes to our mind is investing in gold or silver. So, how exactly does this work? I mean, when markets are jittery, when inflation is going up, even Federal Reserve had said in yesterday's comments that inflation does look like a bit of a problem over the near term. So, at a time like this, can silver and gold provide the hedge against this, turbulence or this concern which is being flagged off by the world's biggest central bank, perhaps.
Yeah. So if you can just hang on for a second, I'll open my presentation here and just let me know you're able to see it.
Yeah, we can.
Oh, okay. Wonderful. So to answer your question, this particular slide here, can you see the slide, Karunya?
Yeah.
Yeah. So see, it's pretty clear that bullion has been a very active hedge against inflation, not only now, even in the past. So that's why I've covered 1970 to 2021, and you can see very clearly that every time inflation has risen, uh, it's gold and silver which rises in line with the inflation or even slightly more. In this slide, you can very clearly see that gold has outpaced inflation by 4.13% and silver by 1.6%. This is just to prove to you that it has a record of performing very well during inflationary times. In fact, the next slide, you can see that even in the shorter term, it's not just 1970, even as early as 2009, when the same situation occurred post 2008 Lehman Brothers crisis, same stuff, same situation came up, and then gold and silver performed extremely well as an inflationary hedge. So both in the short term and in the long term, it has proved itself as one of the best hedges against inflation. So there's absolutely no two ways about it. But the most critical fact I would like to point out is that uh, the real adjusted inflation rate of gold, if you adjust it to inflation, because what price you're seeing of gold today is basically a dollar price. But the real adjusted dollar price, inflation adjusted dollar price is somewhere about 2,200, $300 already. But we are trading at 1,800 as of now. So we are already at a discount. So if it were to catch up, that much of appreciation one can expect, minimum.
But both gold and silver, they have seen some traction lately. Will they sustain the momentum going forward, or as the dollar is expected to strengthen?
See, the traction you're referring to essentially is the volatility that one can notice before any move can happen. And in this case, there's an
Hmm.
expected outflow. But your question is valid that when the dollar is strengthening, gold ideally should not go up because it's inversely correlated with the dollar. But I must point out that there are times uh, in the past when gold and dollar both have gone up together because both are safe havens. So they'll be sought after. Both gold and dollar will be sought after during times of inflation. So this is the particular slide that I just want you to take a look at. When there is an inverse correlation, then gold will find it tough to go. But then when inflation is very strong and then interest rate is going to go up, then naturally gold becomes a compulsive hedge in your portfolio. When you know that the other assets won't do well, physical assets like gold and silver will tend to perform extremely well. Which is why we have seen this in the past. Even in the past, the same thing has happened. Both gold and dollar have gone up together, and it doesn't happen very often. But extreme situations like what we are seeing now, when inflation is really visible, both gold and dollar can go up together.
Okay, fair point. But how do gold and silver, stack up against various metals? If you could, give us a sense of how perhaps something like a silver could be a safe haven at a time like this.
Yeah. Uh, so for that, I'm requesting you to take a look at this particular slide. Now here, you'll notice I've listed all the
Hmm.
commodities on the left, different metals which have shot up lately. and silver. Uh, why have we included silver along with these metals is because silver is an industrial metal also. And it's partly a precious metal, partly industrial metal. You'll
Yeah.
notice that the 1980 highs of these metals vis-a-vis the recent highs, you can see that silver is almost 53% negative, whereas every other commodity has gone up substantially in some cases. So there's a compulsive case for silver to rise simply because it's highly undervalued.
Okay.
Uh, that apart, there is this very strong focus on alternative energy, which the US is now propagating. And I think Biden's policies are all towards green energy. And solar panels are expected to do very well in the US. And silver is an important component in solar panel. So the industrial demand for silver, and even in EV cars, I think a lot of silver is used. So I'm very sure that the kind of undervaluation that we're seeing in silver, and with the sort of future demand that is expected in the industrial side, this is a great opportunity for a long-term investment.
Sure, makes sense. But in general, if we talk about the commodities basket for 2022, how are commodities set to perform, and which ones specifically should investors keep on their radar?
Yeah, that's a tough one because in the beginning of the year things might look different, but as we go towards, there could be many factors that could come into play, and one of the important factors everyone is on the lookout is essentially the dollar and the inflation. So it completely depends on how these two factors are going to play out. And when you talk about both dollar and inflation, I can only see bullion, which could benefit from this whole dollar and inflation play going forward. Now the other metals and the energy markets, though they take direction from the dollar from time to time, they're essentially growth commodities. So when growth is good, both the energy markets and metals tend to perform very well. But when you have inflationary environment, uh, they might suffer, and the kind of growth that we have seen in metals, and the rally that we have seen in metals, the rally that we have seen in energy, might come to an end and possibly even start falling going forward. So bullion to me is one of the best, gold and silver particularly, and
Hmm.
specific metals like aluminium, nickel, and specifically nickel because it's also used a lot in the EV segment. So
Yeah.
these are the three metals that I'll be very closely looking at, which is gold, silver, and nickel.
Okay. But overall, if you look at the energy market dynamics, would you like to flag off some bullish drivers that people can bet on or rely on for growth in 2022 for all the metals that you mentioned?
Yep. So essentially, if you look at the energy market, I think we are already experiencing a lot of supply tightness, and there's a logistic issues that still is underpinning sentiment. Then you have geopolitics, the Middle East situation that could escalate, and the Iran talks failure. That was something which the energy markets were looking forward to. That the Iran talks could fructify and supplies could increase, but that did not happen. And OPEC has many countries which do not have enough reserves. Uh, so it's only Saudi Arabia which has the maximum reserves, and the rest of them are all sort of reaching a peak. And the post-pandemic demand is also very robust. So the energy market dynamics
Hmm.
are pretty strong. Uh, but I must also take you to the negatives. Uh, the high prices are bound to impact demand going forward. Then my own sense is that these logistics issues could get sorted out in the coming quarters. And this geopolitics is unpredictable. Of course, it plays a big role, but it is unpredictable. So
Yeah.
I'll keep it aside. And let's not forget the alternative energy, that's gaining ground. Look at the EV market, the way it is really eating into the fossil fuel demand. And maybe not immediately, but as we go towards the end of the year or early next year, you could see that impacting. Uh, and let's not forget, how crude prices fell down all the way from $140, back in 2008, simply because of this factor that demand was not there at these high prices, and shale oil demand picked up in a big way. And of course, central banks are going to fight against inflation, and they'll ensure that prices are stable. So all these are negative for crude. Uh, so I'm just taking you through a couple
You know,
of
I'm
others.
glad
Yeah.
I'm glad
Sorry.
you brought up crude. I'm glad you brought up crude because that has also been very much in focus. Yesterday we saw it crossed $90 a barrel, first time since 2014, and it is clearly inching towards that important psychological mark of $100 a barrel. What is your assessment of the trend there?
Yeah. So my following slides are going to essentially give an answer to that to some extent. See, EIA is a body which tracks the energy markets very closely. I think they're anticipating production to rise, across the board for all crude
Hmm.
products, natural gas, all the fossil fuels. Uh, but in the near term, though, they're still sort of worried about supplies. So the current trend could sustain for a short period of time, but it's unlikely that it would sustain going forward. Uh, yes, we're near the psychological $100 barrel mark. But as we are nearing, there are tough resistances to cross even at 93, 95. So my own sense is that this particular 93, $95 level is a more important level than the psychological $100 mark. Because many funds look towards this level, and they tend to put a lot of orders uh, to sell at these prices. But as much as we can crystal gaze into all this, it's difficult to predict what Putin will do, what these Ukraine tension, how the situation in Ukraine can escalate. That's difficult to say, but keeping into account that all of it, is pretty much where it is now. With my own personal sense is it should not cross $95. Another $5 kind of an upside looks likely, provided the Ukraine tensions sort of subside. But if it doesn't, then it's difficult to say where it will go and stop. But wherever it goes, I think it will only be a knee-jerk reaction and a short-term reaction. Eventually, prices will have to come back and come back sharply lower, back into the $70, $75 kind of a zone.
Okay, makes sense. But let's say crude can sustain or does sustain above that $100 per barrel level. What kind of impact can be seen on related markets, whether it's equities or bonds? In a hypothetical scenario where crude is above 100 for a fair amount of time, what happens to bonds and equities in that case?
Well, for equities, it's definitely curtains because in a as you know, crude is a growth commodity, and if the energy prices are rising, it would hurt energy cost across the board for all the companies. And this rising cost will, badly hit the P&L of many of these companies, which might get visible maybe not in the immediate quarter, but the quarter subsequently. So clearly, the energy price rise for both the bond market and the equity markets is extremely negative. And in
Hmm.
fact, that's the reason why you have interest rate hikes coming up to counter this rise against energy prices. So this is one of the reasons why I have a very negative view on equity markets, but I'm not an expert in equity markets. I'm just saying purely based on the commodity price movement and the inflation that is expected. I don't expect the equity markets to perform very well this year, purely because of this particular factor, which is the energy markets.
Okay. Okay, makes sense. Let's talk about some more commodities as well. Let me circle back to metals because they've seen a lot of interest from funds last year because of supply tightness, which everybody across the globe was talking about. A lot of industries have been impacted by it as well. So, do you see demand supply trend or demand supply mismatch finally catching up this year or finally getting sorted this year?
Uh, in in all probabilities, it should. If you look at the way in which these metals surged in the last 2 years, it's essentially because of supply-driven factors. It's not that demand suddenly shot up. It was essentially supply-driven factors. And for some of the commodities in the metal basket, uh, it was more to do with specific demand. For example, copper. There was clearly demand across the board in most of the countries, and the way this the EV segment was picking up, copper benefited in a big way, and speculators who sort of speculate in these markets also had a field day because most of them had cheap money to play with, so they were having uh, you know. Dollar available at a close to 0% interest, which they deployed in various assets, including commodities, which might not happen this year simply because the interest rates are rising. So you might not have that
Yeah.
many speculators participating this year, which was the case, the last 2 years. So that one particular factor could ensure that the present rally that we have seen in metals could come to an end or could subside.
Another very interesting space that was hotting up this year was, or the past year rather, was natural gas. We've seen, very significant resistance, though, despite the run up at $5 level. So, what lies ahead for natural gas as a commodity in terms of demand and in terms of performance?
See, we have to understand that natural gas essentially is a highly weather-driven commodity. And during these winter times, it's extremely volatile. Why it shot into prominence recently is because the overall energy market, there was a demand for all kinds of energy products, including natural gas, when when these logistics issues took place. And there was no time where the supplies were less. All the time there was enough supplies. It's just that there wasn't enough logistics to reach it at the right place at the right time, which I think is more or less getting sorted out. The shipping issues, the logistic issues, and even the weather. The U.S. Cold season is midway, but there are a lot of reports that are coming out that it's only going to be a normal one. It's not going to be a very bad weather situation. So keeping that in mind, I
Hmm.
think the $5 level, uh, you know, has a lot of significance because it's a very strong resistance and highly unlikely that it can cross that in the near term, with a lot of these negative factors coming into play.
I'm sure many of our viewers are wondering why the dollar is so important for commodities, and if you could also tell us which ones are more prone to getting affected by dollar movement.
Yeah, that's a very, very interesting question. Now, first of all, we need to understand, why the dollar direction is so important. Uh, Essentially, because the commodities tend to drop when the dollar strengthens, and it tends to sorry, just the opposite. The commodities tend to rise when the dollar weakens, and it tends to uh, uh, you know So there are two sides to it. As the dollar rises, first of all, dollar being uh, a currency which is used in commodity trade across the board. Now, most of the commodities that are traded are in US dollars. So when the price of the dollar rises, then the purchase power starts going down, and the vice versa. When the dollar weakens, then the purchase power starts going up. So the main reason why dollar has such a big impact on most of these commodities is the purchasing power of anyone who's holding dollars and wants to buy commodity, tends to buy more commodities for the same price when the dollar is weakening, and tends to buy lower amount of commodities when the dollar is strengthening. So that's basically why dollar is very important for direction for most commodities. But coming
Okay.
to your next question, yeah, I'm sorry. But coming to your
No,
next
please
question,
go ahead.
yeah. No, you are asking about the gold and dollar. What was the
Yeah.
next part of the question?
I want to ask which are the metals or commodities that are most prone to getting impacted with dollar moves?
Right. Uh, See, basically, most of the commodities are going to be affected. There is no doubt about it because they're all traded in dollars. But
Hmm.
if I have to single out a couple of commodities, it's essentially gold and silver. These are the two commodities that have a direct relationship with gold, and a very strong relationship, more than direct. But this time around, like I said in the beginning, the difference is that the inverse relationship which we saw with the dollar could go away, and both of them might tend to go up together. So both dollar and gold will be sought after as a safe haven. We've seen this in the past. It's not new. We've seen this happening in the past. So I think what you
Hmm.
need to watch out for very closely is both the dollar index and the gold and silver price movement. There are times when this,
Okay.
it might disconnect, but uh, with the potential inflation rising and with the interest rates rising, clearly both are going to rise together, and this is my own sense. Uh, and of course, we'll see in times how it works out.
Okay. Just one last question before we start taking our viewer queries as well. What about agri commodities? Because that's something that, is of great interest and we are yet to touch upon. So if you could talk to us about the cyclicality of agri commodities and how investors and traders should, look at it as an asset class.
Yeah, very good. See, agri commodities also, just like non-agri commodities, are affected by related markets like the dollar. But the biggest difference between the agri and non-agri commodities, even in non-agri commodities, you have cyclicalities. But the cyclicality in agri commodity is much more visible and strong, because something which performed this year will not perform next year. That's the normal rationale. Simply because farmers tend to grow more of that in the coming year.
Yeah.
That's the sort of rationale, uh, and we've seen this happening in the past also. But the conventional dynamics might not tend to work in the current environment which we are right now, because the demand is rising, you have supply problems, and everything else put together, agri commodities are looking very vulnerable, simply because many of them are essential commodities. But there are some
Hmm.
non-essential commodities and also agri, and the demand is likely to stay. But what we saw in the last year is not likely to repeat. That is pretty clear, simply because there is going to be
Okay.
a lot of supplies. The supplies are going to be extremely good going forward. Uh,
Okay.
so the
Okay.
agri, yeah, sorry.
No, please continue.
Yeah. So the agri markets are likely to remain supported in 2022 also because of the upward pressure which we can see on global food prices. Um,
Hmm.
let's not forget that the weather situation has only become more and more unpredictable. Earlier, we know that monsoon is going to set in certain time, and then post that you will have the harvest which will come. But now you have dry weather in South America, and you have unseasonal rains here in Asia. Now both are highly
Hmm.
agri-sensitive sort of places. Now, when you have this kind of disturbing weather, so it just disrupts the entire cycle of planting and harvesting. And this is possibly the trend going forward too, simply because climate change is real. We have to accept that. And with this
Yeah.
kind of a trend, it's very likely that the trend for agri commodity prices that are going to rise will continue to be this way going forward too. So this uncertainty as far as agri commodity prices are real and are likely to sustain even going forward.
Okay. We've been getting a lot of questions as well, through the course of our conversation so far. There are about 10 odd questions that, we've managed to collate from a host of other comments and reactions. Let me start with the first question, which is from Rohit. He wants to ask how one could evaluate Bitcoin as a commodity for trading or for investing purposes.
Honestly, I'm not a Bitcoin expert, and I my views are a little pessimistic there simply because I wouldn't touch something or input my client's money into an asset class which has a huge policy risk overhang.
Yeah.
Yeah, it definitely gives you a potential for returns much faster than other commodity. I mean, compared to other commodities. Um, but I'm in that camp which believes that you know Bitcoin is not something which is to be touched at
No
this point in
worries.
time.
No worries. I won't put you in a spot with that one. Moving on to next question. It's from NK Ramarao. Excluding gold, are prices of commodities season dependent? And how does one choose commodities for a long-term investment when, it's a cyclical or a seasonal thing in nature?
Yeah, that's a very nice question because unlike the equity markets, when you say long term, it can be anywhere between 5 and 10 years. That's not the case in agri commodities because of this very cyclicality. Um, Things
Hmm.
keep changing very fast, and there are lots of factors which can come into play. And since many of these commodities can have a direct impact on a common man and livelihood, governments will do their best to rein in on commodity prices. So,
Hmm.
especially agri commodities, you have to be very careful. There is clearly no long term for agri commodities, but for
Hmm.
non agri, yeah, you have instruments like ETFs which have been launched both for gold and silver. They are wonderful instruments for long term. So, assuming you invest in silver in futures in MCX, every time you roll over that contract, there is a certain amount of premium that you lose. So instead, you simply buy a silver ETF and hold it for the long term. It just benefits you beautifully and sits into this overall long term view. But if you want to play long term and you want to dabble in futures, that might not be a good idea as far as commodities are concerned. In fact, it reminds me that when you talk about long term investment, especially in this country. Uh, it applies to equity markets also, but largely to commodities. Is that an intraday call going wrong becomes a long-term investment?
Hmm. Okay. Sure. Moving on then to next question. This is from Raja. He wants to know, are prices of natural gas in India more influenced by local factors or international factors are at play, and that's where people should focus more on.
Yeah, it's essentially overseas factors. The local factors is hardly any. I mean, it does have no impact at all. In fact, the international markets, and especially there's this place called Henry Hub, where the
Hmm.
the gas movement takes place. And there's a data which comes from the US every week, the EIA data, and that tells you, what's the demand and supply for nat gas. Uh, but apart from that, the local factors hardly play any role at all, except that when you have these policy news about China doing something, and because of that, the energy markets are on fire. In those kind of situations, everything goes up along with crude.
Hmm. Okay. Okay, sure then. Next question coming in from Rajiv. Which metal is likely to benefit most in the long term from global electric vehicle story, EV story? So you did mention nickel, you did mention silver, aluminum. So within these, is there any clear winner that will sure shot do well?
Yeah, I think you missed out on copper, which I said
Yeah, that as well. Yeah.
that's the absolute sure winner, because when you talk about
Okay.
EV, it's nothing but it's an electric vehicle. So every wire that is intertwined inside is going to have copper wires in it. So
Yeah.
kind of copper that goes into building an EV car is phenomenal. In fact, that's one reason why, despite the increase in production of copper that we are expecting going forward. Uh, so I'll take you to the slide just to have a look at. Basically, the International Copper Study Group is anticipating that there could be a rise in production this year because capacities are increasing. But at the same time, uh, if the current geopolitical situation were to escalate, I think it's going to have an impact on all metals, and specifically the EV related metals, which is copper, nickel, and aluminium, and silver to some extent.
Hmm.
So these are the three metals, and copper stands out completely because it's used. I think roughly around 30 to 40% goes into the entire EV cars production. I think copper goes into roughly around 30 to 40%. So clearly, copper is a winner, and because the supplies are going to increase, it's not going to go up the way it went in the last 2 years. And we will not have funds chasing it like what they
Hmm.
did. So you will have good opportunities when it falls. Every now and then you might have a good correction, and you have to keep buying into those dips, and play the long term story.
Okay. Anant also wants to know your view on coal and aluminium. You have elaborated a fair bit on aluminium. Can you shed light on coal?
Yeah, a very broad view on coal, because along with the other markets in the energy pack, I think coal plays an important role because, of course, it's one of the most, uh, I would say, a particular commodity which is dreaded in the entire energy basket. And
Hmm.
till sometime back, most countries are wanting to phase it out, and that's what happened. China did that, but then what happened was the tiff which they had with Australia, China and Australia, that resulted in this coal crisis, which not many people are aware of. So that's how this whole entire coal crisis escalated and become a huge talking point. Um, but as the alternative energy is gaining ground, I'm sure all this will start getting phased out eventually. Not immediately though. I think eventually it will get phased out. I'm pretty sure in the next decade or so. I don't think we'll be talking about coal prices. In fact, LNG has become a much credible alternative to coal lately. Uh, I'm quite negative as far as coal prices are concerned in the longer term, but in the short term, things might continue as the way they are for at least a year or so, a year or two. But when it comes to aluminium, uh, see, the most important thing is that one of the largest producer of aluminium, Rusal, that's in Russia. If the current, Ukraine situation were to escalate, we're talking about almost 6 to 8% of global world supplies from there. That is hurt. Already, aluminum prices are at a peak at nearly all-time highs, and another 10% of
Hmm.
typically what happens is if the commodity moves by let's say 5%, the companies that consume or produce that commodity will go up by at least 3 to 4 times. That's what you've seen in the equity markets. So that's a kind of impact that might have on the equity markets. But in the
Hmm.
commodity markets, it'll be a normal impact because of this a shortage of global oil supplies. So this event risk that's going to happen by way of Ukraine is a very very key thing to watch out for in the coming months.
Okay. Moving on, Ajay has asked us a question. Volumes on MCX commodity options, which is non-agri ones, except for crude, aren't that high. He wants to know if it's a good option to rely on options for hedging risk management or speculative option trading strategies.
I think at this point in time, most of these options that are trading are plain vanilla in nature, and it's better that way because once the markets become more savvy for options in commodities, then the exotic ones will also come in, and there'll be more liquidity for that. But at this point in time, even corporates that are very excited about these options, they're still testing waters.
Hmm.
So the liquidity is not that great at this point in time. So if you are looking at complex products like strangles and straddles, I think they will come in the possible phase two, which could be much later. But as of now, it's just the plain vanilla products which will do well, and it's better to stick to that right now.
Okay. Next viewer, Jayant, has a question. He wants to know your view on MCX offerings for natural gas.
Say that again, currently MCX.
MCX offering options for natural gas. What is your view?
I think it's a wonderful move simply because this is one commodity uh, which can make or break. If you're on the right side, then uh, nothing like it. But the wrong side, things can completely change. In fact, it's such a commodity that it can change direction overnight, despite the fundamentals that can influence it from time to time. Natural gas is an extremely speculative commodity, and it's very important that you have an options product on natural gas. Uh, because what happens is that
Okay.
especially in our kind of markets in India, though investors hear about this word called stop loss, they just don't use it at all because they have their own logic for it that last time they did it, it didn't work for them, or there's this strange metaphor in Hindi they use called "gum fir ke wapas aayega." So prices will anyway go up and down and finally come back.
Hmm.
Why do you have a stop loss? But when you're using an option, the stop loss comes priced into the option. So there's no way out. So if you're, exercising an option, so a stop loss strategy is a part of that. That's the premium that you're paying as a stop loss. If let's say you're buying a call option or a put. So to me, that's the best thing that can happen to investors because I know many investors who have lost their pants when it comes to natural gas. Simply
Okay.
because they've not adhered to risk management strategies like stop losses. So because of that, I think an options would do wonders for the retail market.
Okay, makes sense. Daksh has sent us a question, wants to know, are there any specific expectations and impact of the budget on the commodity market?
See, there are specific commodities which can get impacted because these commodities, they're pricing in a possible duty hike or a cut. But there are certain commodities which have already seen a lot of duty cuts even before the budget. So those, nothing much can happen there. Um, but I think what the market generally is expecting is that the existing duties might be cut in terms of precious metals. This is the market expectation. But my own feeling is it might not,
Hmm.
simply because you know it's not an essential commodity like gold is not an essential commodity like other commodities, which affects the common man. So there will be some amount of duties that might continue as far as gold is concerned. Uh, but there are certain agri
Okay.
commodities where there is a dire need for a cut in duties simply because the international prices are rising. For example, cotton. Now there was a duty hike in the last budget. With the way the international prices of cotton are rising, there's an expectation that could be cut to some extent. But for all this, we should also keep in mind that we are near an election sort of a period. So you have elections in Punjab, you have
Hmm.
elections in UP. They're all important states which are agri focused. So it's very unlikely that the government will tinker much with these duties till the elections get over. That's my own personal sense.
Hmm. Okay. On that note, Gnanasekar, we should wrap this up. We've had a great response from our viewers, lots of questions, but unfortunately, this is all the time we have. So perhaps next time we could, make room for some more queries and questions. But it was a pleasure chatting you. I hope our viewers got to learn a lot from the insights and the information that you shared with us today. Thank you once again, everyone, for tuning in, and Gnanasekar for joining us.
Thank you all. Thank you.